Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 78 unit building, 5 minutes from the Kentucky Derby. Its rents are presently 20% below market for renovated units. To learn more, all you need to do is go to homeinvest.com or click in the description below. Always consult with a tax advisor, financial planner, and/or attorney before making investment decisions. Having said all that, all you need to do to learn more is go to homeinvest.com or click in the description below.
Welcome back to Purpose-Driven Passive Profits. If you are somebody who believes in being a good steward of what God has given to you and you're looking for ways to grow your wealth, you are in the right place. His name is Nate Armstrong. He is the founder and CEO of Home Invest. My name is Steve Warner. I am the Chief Investment Officer, and we are here to share with you how you can wisely invest your money. If you want to drive Lambos and fly around in private planes, this might not be the show for you. But if you are looking for a good, safe way to invest your money, to be a good steward, you're in the right place. Today, we are talking about something called forced appreciation, and it is the whole thing that makes passive syndication multifamily work. So, Nate, just unpack that a little bit. When people hear forced appreciation, some people have a real negative connotation around it. They're like, what does that mean? It sounds bad. Just let's talk about what it is to start.
Yeah. So on a very simple level, we've got a building that we're in the middle of doing forced appreciation on. So let me describe what that actually means. So we bought this building. It needed some cleanup and needed some improvements. The last owners on it, they hadn't increased rents. They hadn't done some of the cosmetic things to make the building look better and landscaping and things like that. Immediately upon us taking over the building, we went in and we implemented the CCM. It's 3 moves CCM. I'll break down each of them in a minute. And what that means is that we're cleaning up the place and then we're renting it out for market rate. So that's forcing the rents to market rate, which is forcing the appreciation on the property. So unlike single family homes, the value is determined by what the other properties in the area are selling for. You've heard comparable market analysis, comparables, comps, et cetera. In a commercial property or a multifamily property, the value of the property is actually driven by the net operating income. So a really simple way to say it is that if you increase the rents, you increase the value of the building. And so that's what we're doing right now. Is it cool if I break down that CCM, that three kind of moves to make that happen?
Okay. So this is what a good syndicator, somebody who says we're going to do a property and you're looking at getting a 25% appreciation across 3 years. This is how they do that.
Yeah. Yep. So the very first one is it's a C. It's clean out. So usually when you enter into these apartment communities, multifamily communities, depending on whether the last owner had on-site management or not, or if they were absentee owners or they were very, very present, sometimes these communities are rough. Sometimes they're great. Usually the great ones have an on-site manager and the owner's very involved in the property. The owner visits frequently. You've probably been to it. Like, Steve, have you ever been to, all of us have probably been to a McDonald's at one point in our life, but have you ever been to like a McDonald's that was good and then you went to another one that you're like, holy cow, this place is dirty? You ever had that feel before?
Absolutely.
Well, the same thing happens with these multifamily communities. And if you're going to demand premium rents out of a building, the only people that are going to pay premium rents are the people that really love their property. And we have to create the right community for that. So step number 1, the first C is clean out. So we go in, we install an on-site manager, and then we're really just trying to clean out the riffraff. People that are either, constantly delinquent on rents, they're messy, they've got pets that they don't keep orderly, whatever the case is, we're going to clean out. And so our moves, they take a little bit longer on the front side to get the right community established. But in the long run, our properties are way better. They perform better. There's less headaches. There's less turnover, all that kind of stuff. So that's the first one.
I mean, we were talking about this on a current property that we're working on. And what's nice is once this is done correctly, those places have a wait list of tenants to move in because people want to live in a clean, safe, well-run place. And if they know that exists, they're going to hear about it from other people. It actually creates a waiting list And that's what we have right now. So, okay, what is number 2, Nate?
Yeah. Yeah. So the second part is create community. And so what we're doing with that is we always improve our common areas. Our common areas are a focal point of all of our properties. So the property that we're talking about, like in this example, in essence, is we've got this property that's got a barbecue area. It's got lounge chairs. Like we repainted it. We put in a new grill. Like we really made the community area good. And so we have our community manager start building community by doing some cookouts, little barbecue, some invites to all the residents. A little touch like that goes a long way because you give the tenants a chance to vent. You give them a chance to build rapport with, or you get to build rapport with them. You get a chance to hear what they think should be improved on the property. And then most importantly, to like solidify building that community is then you have your maintenance guys execute on what the feedback is in the building. And so step 1, clean out. Step 2, build community. Okay. And then what happens is they start referring their friends once you've got community built. Okay. And then step number 3, once you've got the place cleaned out, once you've got the community established, like this is the new bar for the place, then it's time to start marketing. And marketing is pretty simple these days. It's mostly online now, but you run the right online marketing campaign. You start bringing people in. They feel that community vibe. They feel how fresh it is. They feel how clean it is. And then they want to be part of that community too. And so they're willing to pay a premium rent to live there because they feel good. They feel like they can park their car there safely. They can bring their kids there. They can have their pets there. And so that's the 3 steps that we follow on every property. Is it cool, Steve, if I just quickly break down one unit as an example on the power of this CCM principle?
Yeah. So I'm going to frame this one up for you guys. If you're listening, like, so you just heard those things and you're like, yeah, but how does that lead to quote forced appreciation? So I'm going to let you know, Nate will tell you this as well. When you buy an apartment building, something that has several units to it is not appraised the same way that a duplex or a single family is appraised. It's praised based on the income that comes in off of the building. So if you have 10 units, and you raise the rents by $100 per unit, that's $1,000 more per month. That is now $12,000 more per year. As a very simple math, that makes the building worth 10% more if you raised it by 10% in rents. Now, Nate is going to show us exactly how this breaks down. And this is a real life example of the property that we were talking about. This is a property that we own. Nate, go ahead. Let's walk through a unit.
Yeah. And I'm going to read it right off of the Facebook post that I put out last night. I didn't put the address, but I put the exact numbers. So if anybody wants to see the numbers breakdown, find me at Nate Armstrong on social media. You'll see it. And so we had one unit that when we took over the property, it was rented for $870 per month, $870 per month. And we went in and did the 3 phases to the building, the CCM. We cleaned out, we built community, and we started marketing. And we just rented that unit yesterday. We just rented it for $1,200 plus a $100 water surcharge, a $100 parking spot, and a $40 washer and dryer rental. So we took that thing from basically $870 up to $1,440. That's over a $500 increase for one single unit in the building. And now if we multiply that for all of the units in this property, you can imagine what it's going to do. But just one unit, if you take the math on that, following your quick kind of back of the napkin math that you just did, with one unit increasing by $500, we just increased the value of the property by at least 50 grand. I could even arguably say that we actually pushed the value up by around 80 grand based on a six capitalization rate.
So if you think about that across the board, if we do that to all of the units in the building, 25 units, if you do that, think about if we did it by 50,000 times 20, that gets to be a pretty big number pretty quick. I mean, we are into the millions, and this is where you get forced appreciation. So the property goes from being worth 3, 5, 8 million to now 9 million, 10 million. And that's where the exit plan comes in. So now that you guys understand forced appreciation, you know what to look for when somebody is putting a deal in front of you. Did I get that all right, Nate?
You nailed it, man. You nailed it.
Awesome.
Yeah.
So if you guys are listening to this and you're like, well, I'm new to investing, I would love to get involved in some passive deals where my money can work for me and I can make 100% of my money back in a couple of years. Again, we can't make any kind of claims. I know we put a disclaimer on this, but the buildings that we do tend to perform at a 16% IRR, which is a very solid rate of return. You can go to homeinvest.com/podcast. It's linked down below. You can jump on a call with myself. Happy to walk you through the current deals that we have. We actually just finished a raise on a building. Nate, just walk us through the building so people understand the kind of properties that we do.
Yeah, Steve, we're fully subscribed on it, meaning it's 100% sold out. There's no room left on it. So we're only taking backup commitments right now. And I'll describe in just a second, but for you, as if you're looking to place capital, like it's good to have a conversation early and start interviewing your potential partners. And so what Steve just mentioned, like you can go to homeinvest.com/podcast now, and you can book that call to start having that initial interview conversation to see if we're a good fit and mutually see if values align. Anyways, the building that we just sold out, 22 unit building, historic district, walkable to everything, 95% occupied, beautiful, beautiful little property. The thing with it is that the owner hasn't bumped rents in a few years. So we're stepping into I don't want to call it a home run, but it's at least a solid triple where we're going to step in. We'll clean up the building a little bit. We'll increase rents and we'll be on our way. But if you're looking for properties like that one and you want to be part of what we've got going on, then take an opportunity to book a call with us and we can talk to you about future stuff that we've got.
Awesome. All right, guys, until next time, make sure you invest with integrity. We will see you soon.
Bye, guys.
Thanks so much for listening to our show today. Here's Nate with our latest offering.
Oh, so I'm excited to announce this. We've got a 78 unit building, multifamily property. It's 5 minutes from the Kentucky Derby. Its rents are presently 20% below market for renovated units. To learn more, all you need to do is go to homeinvest.com or click in the description below.